Welcome. Excited to talk about IFRS 17 and how BI360 can potentially help you. First of all, let's talk about BI360. It's going to help us for reporting and analytics, used by lots of folks. Real quickly, the bottom layer, just think of that as all your data. So obviously with insurance contracts, we're going to have premium data, policy data, claims data, things of that nature, primarily coming from the ERP system, but it could come also from lots of other places. You may want to bring in payroll data. You want to bring in other data from the general ledger to maybe help out with administrative expenses. So it's essentially we load all the data in the data warehouse, and then we have a reporting and a write back function or budgeting function that's going to build all our reports, and then you can also expose this data to Power BI. Today we'll just simply be loading information from our ERP into the warehouse and using Excel as the report writer to generate those reports. Pretty simple application. All right, let's get started. Insurance contracts. I wanted to start off with a visual of how basically an insurance contract behaves. If you'll notice the first bar, if you will, is our premiums. We're going to collect cash from our customers in advance. If it's a 12-month contract, maybe I prepaid my medical for the next 12 months and I paid $1,200 up front, then essentially I'm going to have insurance coverage for the next 12 months. Effectively, the cost is $100 a month. But essentially, I'm writing premiums up front. If I'm, collecting only monthly premiums, then a lot of this insurance contracts on the earned income may not pay. But in essence, you get cash up front. And then over time with claims, let's stick with that medical policy, I'm going to have claims over time. I might go to the dentist in January and the eye doctor in April. So I'm going to have claims throughout the year. So those are my claims, and for this picture, the assumption is the claims are the same every month. I have the exact amount of claims every single month, and those are my claims. So what happens to my cash balance? All right, when I collect the premium, in this case it's $4 million, let's say, and I start having some claims right away, my cash balance is going to drop just a little bit below that premium amount. And then every single month after that, it's going to drop by the claims. So in this essence, that's how insurance contracts behave. You get cash up front, and then you pay that cash over time to perform paying out claims. So your cash balance goes down over time. So that's basically an insurance contract in a nutshell. Is cash up front, claims over time. So historically, we've been recognizing, or a lot of folks would say, well, I got that $1,200 in cash up front. I'm going to recognize all that as income right away. And then as the claims come in, I'll go ahead and pay them and reduce my P&L. You get a very distorted picture, hence a lot of these standards. One of the standards one of the pieces that IFRS 17 is going to address is when that cash comes in, I haven't earned it. So I've got a lot of unearned income, so I need to set up a liability and earn that income over time. Same thing for claims. As soon as I get that $1,200 in cash, I have to earmark a big chunk of it for claims. I just can't say all of it's mine. I have to provide for claims because I know I'm going to have eye doctors, all those things that I got to take care of on behalf of my client. So same thing, we need to recognize that up front. If I just simply said to add all that income and it was unencumbered, if you will, I might be tempted to spend it on other things. But if I set up a provision for claims, I'm going to be covered. Well, before 17 came out, there was a separate pronouncement handling unearned income. Before 17 came out, there was a separate pronouncement handling provisions. 17 just wraps its arms around it a little bit. And then it just simply says track this over time and then bring it into today's dollars, current cash flows, and then provide a provision for risk, interest risk, all that good stuff. The discount rate that I'm using is simply Fed funds plus 150 basis points. So if today Fed funds is 1.5% plus 150 basis points, I'm using a discount rate of 3%. It's just keeping it current with today's rates. And then the other thing is if the present value, the future cash flows would produce a gain, let's just stop right there. Why would I be in business of charging $1,200 in insurance if I'm going to have claims more than $1,200. That'd be silly. I'd be writing at a loss. So what they're saying is, hey, if the contract indicates a gain, which almost every one of those contracts are going to, because you're going to charge more than you're going to pay out in claims, you just simply have to spread this margin, if you will, over the life of the contract. And that's essentially what 15 and 9 are all about anyways, is unearned income and recognizing it over time, set up a provision for claims up front, and then pay those claims over time against that provision. With all these changes, if you didn't have 9 in place, if you didn't have 15 in place, you're going to have big shock to the income statement. So obviously we need to isolate the impact of IFRS 17 on the income statement, the balance sheet, retained earnings, basically our financials and stuff. So we're going to cover that as well. So let's talk about some of the bullet points of IFRS 17. Its effective date is January 1st, 2021. So it's a few months away. What they're expecting you to do, though, is completely restate 2020. So as I'm filing 2020, don't need to have the IFRS 17 impact in there. But obviously, as I do 2021, I need to have restated 2020 so I can have year-over-year comparisons. As we're going to see later on, when you first implement, it can have a huge impact, especially if you didn't have 9 and 15 in place already. If you already have 9 and 15 in place, basically providing for claims already and deferring income already, you've effectively met 17. All right, let's talk about IFRS 19, or the claims piece of the standard. Essentially, IFRS 19 says you got to recognize any estimated losses or expenses associated with an instrument right up front. So at banks, that's the most common. It's been out there for years and years. I lend out $100, and I'm going to set up a provision for loan losses of 2%, 3%. There's a 3% chance that this loan's going to go bad. So as soon as I lend out that $100, I set a provision for losses of 3%. It's no different from the insurance company. I sell that $1,200 insurance policy, and my claims experience has been basically 80%, then what I'm going to do is recognize or set up a provision of claims of 80% of that $1,200 insurance contract. And then as I pay claims over time, I'm just simply going to charge them to that provision. So I just simply accounted for the claims right up front, and then as those claims come in, I'm going to charge them against the provision. Let's say the contract finally expires and they only had 70% claims and not the full 80. Then I basically reverse that provision because the contract's over with. But initially, you're going to set it up for expected claims, and as those claims pay, you just charge them against the provision, not P&L. That's what 9 is all about. Recognize loss up front and then pay those losses against that provision. All right, now let's talk about IFRS 15, a bunch of different steps. But essentially, IFRS 15 simply says revenue from contracts with customers. If you got cash before you delivered the services or goods, the amount of that cash just needs to be deferred until you can recognize that income over time. Once again, let's use our bank example. We're all familiar with origination fees. I get that mortgage loan and they're wanting to charge me $1,000 for an origination fee on that mortgage loan. What the banks need to do is take that origination fee and technically amortize it over the life of the loan. Insurance companies, exact same thing. I'm getting cash up front. And then how long is this contract for that cash? Is it a 3-month contract? Is it a 12-month contract? A 15-month contract? So what I got to do is take that $1,200, and let's say it's an annual contract. I take the $1,200 and I got to defer the entire amount day one. I haven't earned it yet. Now at the end of the first month, I take 1/12 of that $1,200 contract and recognize it as income. So essentially $100 a month is income over the life of that contract. Next 12 months, contract's fully earned. So I defer it when I receive the cash and then recognize it over the life of the contract. That's basically IFRS 15. A lot of folks have already got that implemented. It's pretty common. Another IFRS 4 that's been out there a while that attacked approached some of the insurance contracts issues from a historical perspective. This has been out there for a while, and this is going to be addressed. But essentially what IFRS 4 says is if I'm an insurer and let's say I'm a reinsurer, so I'm covering other insurance companies for huge natural disasters, Hurricane Katrina, Hurricane Andrew, the wildfires in California. These are just very big natural disasters that just occur outside of your normal everyday underwriting and such. What they're saying is you really can't provide for Hurricane Katrina until Hurricane Katrina has actually hit. You really can't provide for those Malibu wildfires in California until they've hit. So under normal underwriting, yeah, go ahead and set up the provision because we're expecting medical claims, car claims, you name it. For something where it's a reinsurance and it's huge natural disaster event specific, you really can't provide for those until that event's taking place. The other thing is you always want to test for adequacy. You're going to audit, I've provided claims of 80%, but let's say I'm audited, and over time, my claims experience has only been 73%, or maybe it's been 85%. So you're going to periodically test it for accuracy and update it to make sure you're providing enough claims on the front end. You really don't want to wait for experience to play out to figure it out. You want to have that done on the front end. So you're going to test it, periodically, make sure that your provision up front is adequate. The other thing is that provision has to hang out there for the life of the contract. So once again, I got a 12-month medical provision where they pay $1,200 up front. I'm going to reserve or provide for 80% of that at claims. Once that contract's expired and there's no more liability for claims, then I can go ahead and reverse out whatever's left on that contract for the provision. So let's say I provided for $750. The customer only filed $690 worth of claims. Once their contract's over and they can't file any more claims, then I can reverse the difference of that provision and unwind it, if you will, that unused $60. I just simply reverse it out. All right, so now let's go into the mechanics. As I mentioned on the front end, we're going to be using BI360 to track a lot of this stuff. BI360, as I mentioned, is a great data warehouse for gathering claims information, gathering policy information, premiums. And so we're going to go step by step on how do we load all this data in the BI360 in the first place. So BI360 is an app. It's a reporting, budgeting tool. A lot of accountants use it because they're obviously doing reporting and budgeting, but really anyone can use it that has lots of data where they like to present that information maybe in an Excel spreadsheet. So it's a web-based, like I said, it can be on-premise or cloud. It doesn't matter to us where you have it. You can install it anywhere. And it starts off with a data warehouse. You have to start loading your data into the data warehouse. A couple of views of the data warehouse is you have your various tables, accounts payable, my claims table, my general ledger table, policy information, premium information. We're going to be loading all that good stuff. So those are your tables or modules, if you will. The other part is going to be your keys or your indexes. Obviously, I'm tracking, claims status, customer information, employees, renewal codes, periods, policy number, policy types. So all sorts of good stuff. So the first thing we're going to need to do is bring that data into the data warehouse. And I'll just start off with loading policy data. So we can connect directly to virtually any data source. But a lot of our clients have said, you know what, rather than you connecting directly and doing extracts, we would rather just send you CSV files. So in this example here, I'm just showing you some CSV files where the extract has already been pulled out and now it's sort of agnostic to the source, the data source. But obviously we can connect to SQL Server and all sorts of different ways directly to your tables. But a lot of folks would rather just send us the information as opposed to us connecting. All right, so I'm going to pull up the policy data example. And let's go ahead and edit this. And obviously you've got to have your file, my policy data, it's a CSV file, it's 5.5 megs. So I need to do something with that file. I need to map it into my system. So let me go ahead and edit that, and we'll take a peek at what the extract file looked like and what the target data warehouse looks file. So policy data, obviously it's a dimension or a key. I'm just simply loading my keys. I want to have all my policies loaded in the warehouse. So that's basically what we're doing here. The source table, the CSV table, has got policy number, the insured's name, the start date, end date, if it's been canceled or not. That's obviously if they've canceled the policy and there's no more claims coming, then we can unwind the remaining provision. Then obviously the policy year and effective month. We're going to need that. So I'm mapping their source data, the CSV file that they gave us, just simply information on the policy into the data warehouse. And here's my table. It's a policy number table, or dimension, excuse me. This is just the key, code. Then it's got the name of the code, and then I'm just simply mapping that stuff in. Let's take a preview here. And so all it's going to do is simply so there's the policy number, the customer, the start, end date, and then whether it's been canceled. So obviously this one came in, so we're going to take that whatever remaining unearned income and provision of that directly into income. So that's simply loading policy data. If I went back to integrations, we're going to be, I've got another key. This is multi-state, so obviously we want to track our P&Ls by state so we can keep up with taxes and all the filing, the local state agencies, all that good stuff. Lots of renewal code. Think of this in your general ledger. You have GL account codes, revenue account, expense account, claims account. Same thing here with our policy data is we're going to have codes. Is it a renewal? Is it a brand new? Is it the earned income code? Is it the claim code? Those types of things. So those are all my codes, and then they'll have amounts associated with. We've got agencies, we've got product lines, and then the premium data itself. Let's take a look at the premium data. Lots of moving pieces, but we'll just simply continue and just do a quick preview. But you can see lots of data, but let's just preview what it's going to look like in the warehouse. So obviously you've got your company, your scenario, the period, the policies, all sorts of good stuff. But at the end of the day, these are my code. Is it new business? Is it a renewal? Is it a claim? Is it the earned income? We've done a deferral and now we're recognizing income. And then obviously everything else, the agency, the product line, and then the value amount. This is the amount of the renewal. This is the amount of the claim. This is the amount of the earned income. We're just simply going to load that data. When we hit save, continue, what it's going to ask is you to set up a schedule. So obviously you'd be loading claims data at the end of each month, new customer information, policy data. You do it monthly. Some folks would like to do it weekly. So you can load any data anytime. You just set it on a schedule, daily, weekly, hourly, however you want to do it. Set it up, and then all these schedules just run independently. I'm loading policy information, states, renewal codes. So you're going to load all your data into the data warehouse. That's the first step. So in this case, we've loaded our policies over time, and I've loaded them for the last, all of 17 through the middle of 18. All we did is just forecasted that policy information for the rest of this year and built a budget for 19. But it's basically, these are expected policies coming in. Once you've loaded the policy information, we have to come up with the claims, those estimated claims. Once again, as soon as the policy hits the books, IFRS 9, or the claims piece of 17, essentially says as soon as I receive that $1,200, I need to set up that reserve, that claim. So once again, you're just simply going to build those identical records for all those premiums and put in the expected claim. I'm going to show you a model that I did. Basically, these contracts are 12-month contracts. The assumption is they're all prepaying the 12 months. And for purposes of this model, each customer simply has a claim. Business line experiences an 80% claims rate. So I just simply modeled this and said, okay, randomize between 1 and 12, just pick a single month where they're going to file the claim from the date of the premium. Then as far as the claim amount, randomize it between 70 and 90% of the premium. Remember, the average is 80%, so I'm just simply giving them a range. So they're going to file one time, and they're going to have a range of 70 to 90, so the average will come out to 80%. And here's the actual dollar amount of the expected claim for this contract. That's the provision I'm going to set up for that contract and this contract and this contract. If you're a sophisticated underwriter and you've got all this experience, use how you underwrote or how you wrote the premium for that account in the first place. If you expect a 73% claim experience, and if you expect each claimant to have 3 to 4 or 3.5 claims, you can model it so many ways. All I was trying to do is just simply get a cash flow of the claims experience for all these policies, so that I could just simply sum up the cash flow for one policy and say that's the provision I need to set up for this policy day one. So visually, the way it looks, and just simply said, here's my premiums day one, all those claims over the next 12 months, and you can see on average it's around 26 million, 25, but it goes up, it goes down. That's just how randomness is of claims data is. So I get my cash on the front end, almost 400 million, and it drops 25 million over time. So at the end of time, it's basically 80 million is left over. That's my cash. And that I'm going to use to pay administrative expenses and other things like that. But essentially, that's the unclaimed premiums that I get to keep to use for other things. Your underwriters are going to have all this information, so it's not going to be difficult. However you want to do it is acceptable, just needs to be defendable. That's the whole point of IFRS 4. Do you have a reasonable model that can be defended for setting up that provision on the front end? So in BI360 case, we're doing it contract by contract by contract. The reason being is as those claims actually pay out, they're going to go against that provision for that specific contract. And then we're just going to be able to have a provision at every single contract level. Once that contract expires, we just take the balance and take it back into income. So if it's unused provision, it rolls back into income, basically. We unwind the provided expense. If it turns out the other way, they had more claims than the provision, then you would just simply be claiming that as additional expense as they breach that provided amount. So let's say I provided for $750, they made claims of $770, they overused that provision by $20, I can charge $20 extra to expense to cover it for that contract. So the next thing is we're going to book those claims against the provision. So those are my claims over time. As you can see, it takes a while to ramp up. The claims coming in from the first policies take 12 months. So the policies collected in July, August, September are going to have claims spilling over into this year and vice versa. By the time you hit the third year, you're probably going to get a real good run rate of your claims expense. It's now that you've got claims from all your layers hitting on all cylinders, and now you should have a good running claims figure. Now let's go on to the earned income. Same thing as those premiums are coming in. I didn't earn any of that stuff. It's going to take time to earn that over time. So here's the written premiums from the examples before, and then here's what's actually earned. 1/12 of this, 1/12 of this, and 1/12 of this. Or this could be a 9-month contract, and it simply set up records for it to earn over 9 months. It could be a 6-month, a 3-month, or a bullet. It's just simply a 1-month bullet, and all of it's earned in the current month. So here's where your earned income, again, is going to overlap years. I got policies coming in all 12 months, but the policies coming in from July through December aren't earned yet. They're going to basically start earning their bulk this year and then in this year. So once again, by the third year, this is really going to be smoothed out. You're going to have earned income from all your prior layers. You're going to have at least 12, 15, 24 months of earned income layers, should depend on your longest contract. But it's going to take a couple of years for it to really smooth out and start to be close to the cash flow. So once again, let's look at the cash flow, 277, 289, 304. If you'll go to the income, it lags behind, but it will catch up. All right, so that's the mechanics of IFRS 17 at its most basic. Is the guts of it was already out there. IFRS 9 handled claims, set up a provision, and those claims go against the provision over time. IFRS 15 handles unearned income. Get the cash up front, it's all unearned in, and then it just simply earns over the life of the policy. One of the things IFRS 17 would be nice to do is just, I think of it as a materiality piece. But I have premiums coming in. This is a balance sheet play. I have premiums coming in and then claims going out. So I have a lot of cash for that contract on the front end that's sitting in my bank account. And I don't have to do anything with that cash except pay claims over time. So I get to earn interest over time. So based on those balances I've collected but haven't been paid out yet, using my Fed funds plus 150 basis points or 3% on that unused cash position, my interest income for all those 300 million, if you will, in collected premiums, and then less the claims is 2.6 million. So first year I'm getting started. Second year, I built up a sizable cash position. Once again, by the third year, it's smooth. This is your normal run rate. Here's that provision expense. Again, the premiums are coming in up front. I got to recognize provision up front. As soon as I think there's a loss or a potential claim, I have to do that immediately. So this is smooth. So what happens is my earned income gets knocked because it's being deferred, yet I have to recognize all my claims up front. Real hit. And then my G&A is just simply my run rate. This is a $42 million operation for all my salaries, admin people, all those good things. So here's restated after IFRS 17. I've backed out all my collected premiums and only recognized my earned income. And then I've recognized all my claims day one. So you can see there's really no comparability. It wrecks the financial statement. So obviously we want to isolate 17 and show it in a vacuum so we can show its impact. Clearly by the third year, its impact becomes much, much less, much less impact. So that's your income statement. We've got to obviously trap IFRS 17 as it's getting adopted. And you can see why they want you to go back a year first before you start presenting, because the first year of implementation is a radical hit to your P&L. I'm deferring all my income, yet I'm recognizing all my expense. So that's a radical hit. So they're saying, hey, get that behind you as far as restatement. And let's just say this is our first year under IFRS 17, and this is just for comparison purposes. You can see huge differences. We're going to trap those differences. Now let's go to our cash flow. Because at the end of the day, this is what we all live for, is cash. That's what we're going after, is more money in my pocket. So we're going to look at the policies. This is the money coming in to the insurance company. We're collecting 277 million, 289, 304. So nice, healthy growth over time. The interest income is just simply a function of cash flow, collecting cash on those unused cash balances. If you have the money coming in, interest income, and then these are my claims, not the provision. This is the actual payout. And you can see the claims closely follows the P&L. It's just simply going to track well with that. So that's the cash flow. I got money coming in, money going out for claims, and then my G&A, all my staff salaries, all that good stuff. And so now my cash flow first year is the hugest, obviously, because I get all this cash, yet I have 12 months to pay off those claims. Second year, not as bad, because I'm continuing to pay claims from the first year and starting to pay claims from the second year. So you can see cash flow drastically starts to follow your normal flow, and then the third year, this, steady as she goes. So again, you can even see it makes more sense why I want to adopt with a retrospective year under adoption, because cash flow is huge too. I mean, big changes and such. So I really like IFRS 17 restating the prior year and the current year, and then presenting. So a lot of big changes. How do we trap IFRS 17 in a vacuum so that the reader of the report understands what this company is all about? I mean, that's the whole goal here, is before I invest in this company or even as management, I want to get a good feel. So now let's go back. I got this backwards. So these first three columns is 17, and the next three columns is 18. I got that back. So let's just say this is the restatement of the prior year. So if I go all the way down, you can see I backed out all my income and recognized a much lower one. Claims, I backed out the claims and went to a provided. So this is your 15 effect, IFRS 15, changing from cash flow to a unearned income approach. I got to earn that income to show it. And then this is going from a cash flow paying claims to providing for all those claims day one. So it's a double whammy. I reversed income, recognized less. I reversed claims and recognized a lot more. Double whammy. So you can see it's a huge impact to the profit. And of course, you want to break out income tax. But at the end of the day, it's a huge impact. The second year, the year that I'm sort of restating everything, you can see the impact drops dramatically, because now I've got earned income flowing into the second year. I've got claims flowing into the second year. So now it's starting to normalize it. Like I was saying before, once you hit the third year, it really starts to smooth out. And this impact should get less and less over time, because you've been providing and you've been deferring income and providing for claims up front, and this effect goes away. But that's the whole point of IFRS 17, is what's the impact? Now, if I've already adopted 9, if I've already adopted 15, then this restatement column, as I back those out and push this back in, is going to be virtually nothing, because you've already been doing the unearned income over time and the upfront recognition of the claims. 17 just simply wraps it around in one statement. But effectively, there's no need to wait. Go ahead and start filing under 17 today, because the impact is going to be very little. You've already been, doing the unearned income and the claims. It's just wrapping it together and maybe a few more disclosures and stuff. So if you've got 9 and 15 implemented, go ahead and do it now. There's no need to wait. Get that thing implemented. The impact to your income statements, it's going to be very little. It's not going to change all that much. All right, and then we go on to the comprehensive. So if we've got, the bottom of the year is 298 and 13 are my impacts. On my other comprehensive income statement, obviously you'll show your regular operations and then the effect of IFRS 17. What's the impact of this pronouncement? Obviously, if you have 9 and 15 in place already, this is going to be much closer to zero, obviously, over time. As you get to the balance sheet, same thing. You're going to have this deferred revenue. You're going to have these accrued claims. Those are the big hits. And to the extent it affects his taxes, that restatement, that $298 million restatement, you're going to be affecting taxes somewhat as well. So you have a deferred tax liability, because Uncle Sam tends to follow the cash flow more than it does for provisions and all the unearned income and stuff. But there'll always be a timing difference. So we'll have that on our balance sheet as well. You're going to obviously hit retained earnings from prior hits, and then for the current year as well. So that's basically it. You'll have a couple of changes to your liability section to set up the deferred revenue and the accrued claims, and then whatever direction your deferred tax liability is going to take. All that typically exists in the liability section, and then the retained earnings obviously is what was the impact of the implementation previously, and then the current year. that type of stuff. So you can see as you go out in years that starts to diminish more and more. So let's go into our BI3. So we've loaded lots of data. We haven't really got into live reporting at all. So I'll go ahead and pull up this report, this template here. And it's just the moving pieces, everything here. So I'll simply open it all up. And now you can see every single month, what are my policies being received? Because I'm loading data every single month. BI360 is a forecasting and budgeting solution as well. So all I did is just simply forecasted future policy receipts. It is seasonal, and I just simply said whatever it was 12 months ago, add 5% to it. They're growing, but in reality, this company will go ahead and make their own changes. It all starts with the policies, and then from there, you're going ahead and deferring the full amount of the policy, and then recognizing them over time. Those provisions are done on the front end, so whatever the policy was, if it was a car policy, a 6-month car policy, or provision experience of 28, whatever the number is, your underwriters are going to have all the information. So you'll be setting up the provisions. The claims obviously will be on a cash flow basis as they come in and they're paid out. They're being booked against the provision and such. And then this is just simply keeping track of what was earned, the interest on the the cash balance, if you will, and everything is drillable. That's what's nice about this as well. Is with BI360, any report that you design, you're going to have drill down capabilities to the underlying data. Now, since this has lots and lots of policies and thousands of records, such that drill down, if you're drilling into earned income, you might have a few policies that you're going after. Let's see what's yeah, so you're going to have all this good information. It's just to be able to drill into it. You can export it to Excel. If you want to edit this report, let me just pull up the editor. I don't want to spend too much time because the focus is obviously on IFRS 17. But going into the editor, let it load here. I'm going to pull up my policy data. Premium data, excuse me. Get this out of the way and fully expose the report, premium data. What's so cool about BI360 is it lists all your data warehouse tables here on the left, and it's just simply a drag and drop tool at the time. I'm using every bit of Excel, hiding columns, I've got some functions, got variances, all sorts of good stuff. And all I'm doing is dragging and dropping stuff. So like product line and the product line, that new issue code here. So I've got the renewals and new as my my code, and those are my policies. On here I've got an E, the renewal code is an E, and I've got all my earned income, a P for my provision where I provided for it, and C for claims, the cash flow. Those are the 4 moving pieces you need really for everything. So I'm just simply listing all that information. The value is the premium amount. This is the sum of everything. So this is year 1, year 2, and year 3, or history, forecast, and budget. So that's all I'm doing is I'm just dragging and dropping in fields. If I want to run it just to test it to see what it looks like, I hit that run function, hit run. You'll notice I've got everything exposed, but I just want to show all the columns and fields that it brings in. So here's everything fully laid out every single month, all that good stuff. Kind of a busy report, so all I decided to do is group the individual months so I could just see the years. So it'll make it easier on the eyes, but everything is there. You drill down. If I got a report, the layout that I like to get started, then I just simply come back to design mode and hit save, and it just simply pushes it back up to the web portal. And there you go. So that's sort of my working papers, if you will, to keep track of the cash flows, to keep track of earn, keep track of claim, keep track of provision. As you're building your financial statements, you obviously want to track the IFRS 17 impact in a vacuum. If you already have IFRS 9, setting up the provision for claims, and IFRS 15, deferring income, If you already got that set up, effectively, you've been handling 17, most of 17. So you can go ahead and adopt now. If you haven't any of that stuff in place, 17 is going to have a radical impact on your income statement come 2021, and that's why you need to sort of get started now to see what that impact is on 20, have all your ducks in a row so that when you do start reporting for 2021, you've got all these layers in place, you've been doing it a while, you've got good experience, you've validated the model and such, and then when it's time to actually show the reporting, everything's defensible. It's all set down. But once again, if you got 9 and 15 in place, let's go ahead and get started now. Don't wait. If you don't have any of that in place, yeah, you're going to have a big restatement coming. We've covered that. If you've got any questions as a follow-up, you can always reach out to us at info@solverglobal.com. If you've got a partner, maybe you're working with a partner of ours at Solver, contact them and learn a little bit more about IFRS 17 implementation and how we can help. I hope you found this helpful. Once again, this is Dan Havey from Solver, walking you through IFRS 17 insurance contracts. Hope you have a great day.